And welcome back to the Lance Roberts Show podcast. I'm your host, Lance Roberts. J. Brett Freese, CFA, our guest. Of course, he is the Director of Global Technical Analysis and has a great website and research that you can log on to at his website. And what is that website, Brett?
GlobalTechnicalAnalysis.com.
Couldn't make it any easier. There you go. So, Brett, we were just talking about a second ago about this, this market rally here, where it might go to over the next couple of months, potentially getting back up here into the 2,700 level. Now, the general belief is, if you listen to the mainstream media, listen to, kind of market commentary in general, is that one, there is no recession in sight, even though we are 5 months away from the longest economic cycle on record. Absolutely no recession in sight, which means that there's no real potential here for a bear market. But one of the things that you're kind of discussing here is that you think a bear market may have actually already started, and we're just within a kind of a reflexive bounce within that overall bear market. Is that a fair statement?
That is very fair. I think that prices lead. So prices lead going into economic declines, and prices lead coming out of economic declines. And so I think we've seen the first move in prices. I think the fundamentals will follow. I am a firm believer that I'm going to take the importance of price information over the importance of fundamentals every time.
Well, that kind of brings up this other graph you have here. Let's bring this graph up here so that everybody can see this. This is a monthly graph of the S&P, which is also showing kind of these price trends and kind of the setup you're talking about. Can you tell us a little bit more about this?
Yes. So this is the S&P 500 index, and I actually prepared this graph before I did the long-term Dow Jones graph. But what you'll see is that this graph covers 1957 through 2018. So it's the fifth leg of the other graph that we were talking about, and it just kind of zooms in on it. And so when I think about potentially where the theory suggests that the correction could go to, at an absolute minimum, I think that we can take out the lows of 10 years ago. And when
wait, hold on just 1 second, because I want to make sure everybody understands what you just said there. You think that where this potential market decline could go is you could take out the lows from December of 2008?
Yes.
That's a scary proposition.
It is a scary proposition, but you do a lot of fundamental work, as do I. And my fundamental work suggests that you could easily have a 60% decline in valuations, which gets you in the same ballpark.
Right.
So I've got a fundamental valuation that tells me or doesn't tell me, it suggests that 60% decline isn't out of the picture. And then I've got a totally different methodology that puts me in the same ballpark. So I'm pretty confident that that if market participants really want to take this thing down, that would be a reasonable target.
Okay. All right. So
it's not necessarily a forecast. It's, again, what I spend my time looking at is probabilities and potential market moves.
Right.
And then I use my primary methodology to really drill down month to month, week to week, to what's the best way to say it? To kind of reinforce what the broader picture suggests can happen.
Right. Okay. Because we're talking about here, there's a lot of things that could actually lead up to this decline, and we've talked about this before, which is, We've had a massive surge in, debt issuance. We've had, decades of low interest, or a decade of, ultra low interest rates, ultra accommodative policy, and prices have simply gone very far beyond the actual underlying fundamentals. If you take a look at revenue growth versus profit growth, huge detachments that have not historically happened, ever before in history. So just to realign some of those underlying fundamentals, it would require the type of price decline that you're talking about here. And of course, we're not even talking about the potential of the demographic issues that are coming up as baby boomers become extractors of capital from the markets. And of course, and that's not just demographically in the U.S., but globally as well. Interesting article out yesterday that we've got coming up talking about the ineffectiveness potentially of the Fed. The Fed's at 2.25% now on interest rates. Typically during a recession and during a market decline, they have to lower rates by at least 4% to 5% to combat that decline. They simply don't have the tools available. So, while the proposition of a 60 or 70 or 80% decline in the market seems to be outlandish, I mean, that's just crazy talk, Brett. The fundamentals actually do support it.
I agree. And, you can go back and look during history at market performance when the Fed was actively cutting rates. And you can find episodes where the market declined while the Fed was cutting all the way down. Mm-hmm. And so I'm not necessarily convinced that market participants' reaction to an end of the rate hike cycle or the beginning of a rate cutting cycle or the end of quantitative tightening, or God help us if they balloon the balance sheet even more.
Right.
I'm not sure that market participants' reactions would be the same. But again, that's why I like technical analysis and just studying price, because to me, price tells the truth. And it gets around, kind of these macro, not to denigrate global macroeconomics, because I spend a lot of time doing fundamental work and thinking about macro, but it's more story oriented.
Right.
I guess is what I'm saying. And I'm much more inclined to believe something like price, which, markets are essentially the product of price and speculation. Mm-hmm. And nobody can manipulate the price that is traded each and every day. There's a buyer and a seller, and they agree upon a price. So to me, that's the only truth in markets. And it tells you a lot if you take, the time to study these different theories and methodologies. And I like to think of myself as, I tell people I draw maps. I don't make forecast, but I can give you a map that, if you're going down the road and you don't know your ultimate destination, but you start passing landmarks, you can pretty much figure out what your end destination is.
Right.
And that's what my technical analysis does. I don't know where the market's going, but I know that if we pass certain price landmarks in either direction, that there's a pretty good chance that the ultimate target is this price or that price, higher or lower.
Yeah. Well, I think it's a good point. Two things that you bring up here is that one is, the macro views, right? When you talk about fundamentals and economics and these type of things, those are just views about where things are currently in the world. Price is a reflection of market psychology. And to your point, it is the reflection of what buyers and sellers are doing. As the old saying goes, for every transaction, there's a buyer and a seller, and they both think they're astute. So, it's one of the issues that is very important. A lot of people poo-poo technical analysis as kind of mumbo jumbo, but it is the direct reflection of what's happening in the market and what market players think.
Yes, and I'm not going to criticize how anybody approaches markets. I mean, if you have a methodology that's fundamentally based and it works for you, by all means, keep doing it. But what I will say is that the naysayers against technical analysis are partly what allow people like me to take advantage of opportunities in the marketplace.
Yeah, exactly. Well, Brett, any closing thoughts for the day? We're talking about this kind of, potential setup here for a rally that will likely be a great shortable opportunity for investors. What's the final takeaway?
The final takeaway is to be patient, wait for a 2-month high in S&Ps or a 2-month high in crude oil. We need 2-month lows in interest rate futures. Mm-hmm. And when those opportunities present themselves, take the other side of it, because there's a fairly good probability that you'll never be challenged, and you'll catch the next leg down in stocks and up in interest rates.
Well, when that happens and we begin to reverse this bounce, we need to get you back on so we can find out where we go to next.
Yes, sir.
All right.
Anytime.
Absolutely. And make sure that you follow our website, realinvestmentadvice.com, and subscribe to riapro.net, because both those websites, we feature writings from J. Brett Freese. Great work. He's nailed the market turns exactly on the head here over the last several months. We continue to look forward to working with Brett in the future and posting more of his work. Be sure and find it all along with this podcast at realinvestmentadvice.com. Simply go to the podcast tab or to our YouTube channel, LanceRobertsShow.com. We'll see you next time.
Want a longer talk with Lance about your money? Request a personal one-on-one at realinvestmentadvice.com. It's a rich man's world.